I'm Brent Joyce, Chief Investment Strategist at BMO Private Wealth. It's Thursday, January 29th. Welcome to our Global Markets Commentary. The theme song for January could be Talking Heads' Once in a Lifetime, where the chorus, same as it ever was, repeats over and over. January saw many of the major themes from 2025 continue. And in case you haven't looked at how 2025 went, it was a banner year for stocks and an okay one for bonds. So despite the continuation of gloomy headlines, capital markets continue to roll. Same as it ever was extends almost to the letter of 2025. Canadian equity markets, emerging markets, and Japan are leading the charge, up mid-single digits for January alone. Shares of small and medium-sized businesses who came alive in the second half of 2025 are continuing their rip. The Canadian Small Cap Index has added a mid-teens gain in January to the 50% gain it made in 2025. These assets are exiting a multi-year walk in the wilderness where they underperformed, and as such remain undervalued on many metrics compared to their large company cousins. Also rhyming with 2025 is weakness for the US dollar and strength for gold. Same as it ever was extends to the litany of chaotic headlines on politics and geopolitics. Thankfully, similar to 2025, capital markets continue to show resilience, defiance in some cases perhaps. Equity and bond markets reacted to the sad and incredulous events by continuing to deliver the important feedback policymakers need, reminding world leaders that decisions and actions have ramifications for the real economy. The geopolitical developments of early January saw stocks stumble and bond yields rise before the tone changed and capital markets went back to focusing on all of the positives underpinning the world economy. Despite being grumpy, a consumer that continues to spend, businesses continuing to invest in technology and beyond, a decent trajectory for inflation, and labor markets stuck in a no hire but no fire holding pattern that is appropriate given the immigration backdrop in North America. The state of inflation and labor markets are allowing central banks to keep financial conditions loose, and equity markets love it. Add into the mix strong nominal economic growth. That's real economic growth plus inflation, along with signs of productivity gains, and it all leads to robust earnings growth expectations for corporations. Expectations that are being confirmed by the latest round of company earnings reporting. We'll add another theme from 2025 that is the same as it ever was. The headlines are the headlines, but earnings are everything. And unless the headline threatens to dampen global growth or increase costs through inflation, oil prices, wages, taxes, or borrowing costs, markets are focused on the earnings, and rightly so. Venezuela and Greenland don't move the needle on any of these fronts. Maybe Iran will for oil, we remain watchful, but the world is awash in oil, so the impact could be limited. Borrowing costs remain reasonable, and both the Federal Reserve and Bank of Canada stayed on hold. More same as it ever was. The feedback loops from stocks and bonds don't play favorites. They don't care which country needs the feedback. That's the beauty of a globally interconnected financial market. The signals sent are more powerful because of the linkages, and they call attention beyond the borders of any one nation. January saw important feedback from the bond market doled out to the leaders of Japan. Japanese government borrowing costs rose dramatically in response to a snap election that might usher in more government stimulus. Japanese officials quickly made overtures to reassure the markets, and Japanese bond yields fell. To be clear, Japanese government bond yields are rising, but so is Japanese inflation, which is not a bad thing after decades of poisonous deflation. Japanese real economic growth is also much improved. So for these reasons, higher Japanese bond yields are justifiable, a long time coming, and can be digested by global markets if the movement is orderly. Japanese bond yields have been rising for 4 years. That's what you'd call orderly. There are limits, but borrowing costs in Japan are still lower than any other developed country. So there is further room for them to continue to climb before they become a negative factor for other global bond markets and in turn, possibly stock markets. The start of 2026 has reminded us of one other same as it ever was. As investors, we need to continue to keep politics out of our investment portfolios. That's the way we saw the opening month of 2026. Thank you for joining us. We look forward to you tuning in next month.